Hello, thank you for joining me, Julie Farrell with Director's Mortgage, and welcome to another episode of Julie Does Loans, Between Two Loans. So I'm here with Scott Hale, the AVP of Underwriting for Director's Mortgage, and one of my favorite ops people to talk to because you're just a huge resource for me, and I usually don't reach out without a rather large quandary, and you always help me unscramble it.
Good.
So thank you for that.
You're welcome.
Scott's been with Director's Mortgage for over 8 years now and over 22 years in underwriting and loss mitigation and credit analysis and risk.
Yes.
That's a long time.
It is a long time. It is, yes.
So thank you for joining me.
Yeah, of course.
I've got just a couple of quick questions that I wanted to go over. Not that we need to quickly answer, but just some thoughts. We're going to stay focused on just a few items today, and then hopefully you'll join me again for more thoughts later.
Love to.
Cool. So one of the things that I wanted to hit on was for our self-employed borrowers. And first, I'm going to define what a self-employed borrower is. Mm-hmm. That is someone that owns 25% or more of any one entity is considered a self-employed borrower. So you may not be a 100% owner, but if it's more than 25% ownership interest in a business, then we consider that self-employed. And there's been some interesting changes to how that income is calculated. When COVID hit, changes were put in place to protect conventional financing. And those were not only did we need 2 years worth of federal tax returns for review, but we also needed to see a year-to-date profit and loss statement, as well as 3 months worth of business bank statements to prove that you had not felt negative impacts of COVID. Correct?
Correct.
Okay.
Yep.
So those have been lifted in 2022 for conventional financing only.
Yes.
So,
for conventional financing, the COVID restrictions per the mortgagee letter of Fannie Mae have been lifted actually as of I believe it was the end of September. Every company kind of quote unquote agreed to it and decided to follow along with the Fannie Mae and Freddie Mac uplifting of the restrictions. And that puts us in our space right now. The good news about that is it will offer less documentation needed and provided for self-employed borrowers, as you mentioned earlier, for those that are 25% or greater ownership in a business. And what that does is a P&L is not necessarily required anymore.
right.
And the only time that that's going to be required is if it is requested by an underwriter on underwriting review, but it's not a Fannie Mae mandate. The only time it comes into play is if the Fannie Mae mandate is if you're over 120 days from application date.
And that's interesting. So we were going through this example of what that means. So self-employed borrower makes application in January, finds home in February, and closes in March. We would need whatever the automated underwriting system told us.
Correct.
Maybe that's 1 year of tax returns, maybe that's 2. But we would not need the 3 months worth of bank statements. We would not need a profit and loss statement, making it easier and less documentation
Correct.
for our self-employed borrowers.
Correct.
Awesome.
Yep.
But if you make application and wait 120 days to close or are just having a hard time getting into a property, a profit and loss would be required
That's
for
correct.
underwriting.
That's correct.
Okay, so make application, find a home quick for our self-employed clients is
Yes.
how
and
you avoid a profit and loss.
the reason for that is when they have developed these analysis through credit risk, they deemed that 90-day period to be 90 to 120-day period to be a substantial change of when a business can fluctuate within profit and or loss.
It's a good snippet
Right.
of
how the business is doing.
right.
For example, I mean, if you take application in January and you're closing in February, the old restrictions had us get a P&L for the 1 month, which really isn't a really great indicator of how that business is performing.
No.
So they did deem 90 to 120 days is a good analysis of how a business is performing. So what they said was, if you take application in January, so you have your previous tax returns or two, like you mentioned, and you're not closing till June, 6 months have gone by. Well, we're going to want to see how that business has been performing in the first 6 months.
And that makes sense. I mean, that's what
it is more of a make sense type of a thing rather
Right.
than a COVID restriction. Correct.
Fantastic. I think we've really done a good job of covering that.
We did a great job of covering that.
Thank
yes.
you. So, next question, and I was kind of steering you with this one.
Sure.
But what is the most unique way to underwrite income currently for conventional financing?
Okay.
Because there's different income approaches,
Mhm.
but what's your favorite, most interesting way?
Well, I'm going to say there's two. The first one that a lot of people are not aware of is when you take application and credit, we run you through with the AUS system. Those of you
Automated underwriting system.
automated underwriting system, which gives you kind of a guideline for an assessment of your credit profile, your risk, and also some things within the application that you take that it wants to point out. One of the unique things is that some people are not aware of is that within the Fannie Mae guidelines, you can have what's called a day one certainty, which will offer, basically it will take information from your employer and say, hey, this is the income that we have came up with for your borrower. You can use this to qualify. Since COVID has been lifted, that is all we need. We don't need pay stubs. We don't need bank statement or anything in regards to
No W-2s.
No W-2s.
Right.
No tax returns. Nothing. If that AUS is agreeing to that income, then that is something that we as underwriters and as a company can accept. Now, you're not always going to get that.
Right.
That has a very specific borrower percentage that will allow that, but it is an option. It is unique.
And it is interesting.
And it is interesting,
Yes.
yes. The second one would be asset depletion.
That one's so cool.
We talked about. Freddie Mac actually has a very unique asset depletion program in which you have eligible assets such as a 401k, an IRA, an employee holding an account, thrift and profit sharing.
So who this is really geared for are our fixed income borrowers that are of retirement age, so 62 and older,
Yep.
that are worried about qualifying. Hey, I don't have income because I have very little coming in Social Security, or maybe nothing coming in Social Security. However, I have all of these assets.
Right. This really does point to those type of borrowers that have good credit and they have a steady income, maybe Social Security and maybe a small pension, and they want to buy a house and they have $1 million sitting in their 401k, and they know they can afford the payment because of that asset. Freddie does offer an asset dissipation program that will allow you to utilize that $1 million and actually come up with a monthly income figure to help a borrower like that qualify.
Right. So they take the asset as a whole
Yep.
and divide it by 20 years, 240 months,
Correct.
to derive a monthly income level that we can use to qualify them for conventional financing. That's a really cool
That is correct.
tool.
Yep, that is correct.
Thank you for sharing that.
Yes.
It's awesome.
Sure.
Okay, so knowing all that you know, with over 22 years experience and over 8 years at Directors, what would be the one piece of advice that you would give new applicants going into a mortgage loan application?
Find a lender and a loan officer that you can build and have a strong relationship with. That's what I would tell you. There's so many reasons for that, such as it can be your lender for life, so to speak. Someone that you can go to when you have a question regarding a credit or a credit score, or I want to do this, I want to build my portfolio and buy an investment property.
I love this answer. This is so much better than I would have ever expected. Yes, a relationship is so important for all of those reasons, because a mortgage fits into your overall assets as usually your largest debt and your largest asset. How does it play in with everything else that you've got going on? We need to be talking to your insurance provider, your wealth manager, and making sure that you've got a whole team of people that are looking at your goals and objectives and giving you good guidance to get there. And then hopefully being a repeat person in your life. I know for myself, I reach out to my clients annually, and it's so much fun to reconnect and then to be working on my third, fourth, fifth transaction with them or their kids, or now their kids' kids. Well, Scott, thank you so much for your time. I appreciate it. This has been awesome.
Yes, absolutely. Anytime.
All right.